Welcome to another episode of Jazz TV Show, guys. I have our very senior mortgage broker, Somil, with me today. We had a few other podcasts done with them. And you know what? The exciting part is that we had a great response last time. His insights about the market and insights about the finance is always helping. And one of the go-to person that I really truly believe is a person that we can absolutely take advice from. Welcome to the show again, Somil.
Thank you, Jazz. It's always a pleasure to come and have a quick chat about things that's going
Absolutely.
on around. So
It's been a while since we last did our podcast. Did you miss me?
I absolutely do. And that's why I wanted to keep connecting with you as well. So
Thank you.
unfortunately, due to restrictive timelines, we were not able to catch up. But then, yeah, really excited for today's
Thank
podcast.
you. Thank you so much for that. So tell us a little bit more about, of course, I've got some questions that I'll ask you, if
Yep.
that's okay.
Yep.
What's happening in the finance world at the moment? What's the gossip and what's the news?
Yeah, you would have already heard about this, but there's lots happening in the finance world at the moment, especially with the rate rise that recently went through of
Yeah.
0.25% from RBA, which all the lenders, or I would say most of the lenders, have already passed on.
Right.
All the big four banks and their subsidiaries have already passed on the rate rise
Got
to
it.
all of their existing as well as new customers.
Right.
So I think one of the nervous feelings all of my customers, or in general the sentiment of everyone around us, is what happens next, and will there be another
Exactly.
rate rise, will there be
Exactly.
rate cuts? So there's a lot of discussion happening, particularly
Yeah.
around the 2.25 rate rise recently that
Right.
happened. I think it also comes down to how the things are looking in the future as well, with inflationary side of things as well.
True.
Because that's one of the core decision based on which RBA is able to make whether to increase or not.
Yeah.
But at the same time, yeah, there is lots more than that. So
Got
when
it.
we just start thinking about rate rises, we always monitor just inflationary measures.
Got it.
But there is a lot more things that goes in the back end.
I'll ask
beyond-
you on that for
Yep.
sure, because we would love to know some insights on that.
Yep.
You were saying that people have obviously questions around what's going to happen, and I feel you're absolutely right, and you will be the best person to give me some more insights on that.
Yep.
Now, every person would be going through a different journey and cycle right now. Some people might be going through refinancing.
Yes.
Some people are going through first home buying journey.
Yep.
Some people will be going for a second home or an investment, upgraders, downsizers. And the common question comes in is, let's say, I'll give you an example. Like, as me, for an example, if I ask a question on the certainty, uncertainty about real estate market, because that all depends, on the buyer behavior and the sentiment. So how are you feeling the buyer sentiment and your clientele
Yep.
who you're currently working with or in your industry?
Yep.
What sort of commentary are you getting on the buyer behavior and sentiment, how they reacted to it?
I think the reaction was because it came out all over in media as well that it's increased. So
Okay.
there was definitely a little bit of a shock for everyone.
Right.
Because nobody expected, and people haven't seen that rate rise phase in the
Got
last
it.
2 years.
Okay.
So it's been a while that the first
Yeah.
rate rise happened. We saw that during COVID and post-COVID period, I should say.
Right.
Where there were back-to-back rate rises. So for someone who has got a home loan for more than 5 years, or
Got
in
it.
the last 5 years or so, they're used to seeing those rate rises.
Right.
But then someone who has got a loan in the last 12 months or 24 months, for them it came in as a little bit of a shocker in
Right.
terms of, okay, my repayments are going up, especially if they are
That
on
is
variable
another way
rate
to
loan.
look at it.
Yeah, so there has been mixed
Yeah.
reactions to it.
Got it.
And yeah, personally, I just feel that rate rise also doesn't just impact your future purchase of the property transaction itself, but it also impacts your existing loans as well. So that is
Right.
something to keep in mind, especially if you are an investor looking to go for your third property, fourth property,
Yeah.
second property. Borrowing capacity is just not impacted for that new property purchase, but also for any existing loans that you have. Your repayments are likely to go up if it is on a variable rate
Yeah,
loan.
yeah.
So that actually significantly impacts their borrowing capacity,
Okay.
which a lot of people don't factor that in
Got
when
it.
they are assessing their borrowing capacity. So it's really ideal to get it checked with a professional in terms of
Yeah.
how your borrowing capacity looks like
Okay.
before you end up signing contracts, only to know later that you potentially can't service the loan.
Right. Okay. So, give me an example. Now, again, you were saying that's a really valid point.
Yeah.
If someone has just got a mortgage,
Yes.
let's say 12 months ago, or
Yep.
even let's say 6 months ago,
Yep.
and they're first home buyers,
Yes.
were they not expecting another rate rise, or they were not completely aware? Because it's fair to say a lot of people who jump into a buying market, and a lot of people who are really not experienced in buying and selling real estate, for
Yep.
them it's probably first time, and they don't have even a sight of buying an investment because they've probably just planned for first time
Yep.
at this stage, and obviously they need more guidance, and that's a different topic.
Yep.
So, do you think there's people who may have not kept a track
Yep.
on the past rate rises, and they've just got into the market where when they were ready to go? Or you reckon majority of the consumers or the community across the country was fully aware about rate rises and they were not expecting
Yep.
another rate rise? I wasn't
Yep.
as well.
Yeah.
Being in the industry, I was not under the impression once we started seeing the pattern. Yes, they
course.
were holding it,
Yep.
and the pattern that we saw,
Yep.
every commentary that we've heard
Yes.
was more around that they are trying to keep it around that level,
Yep.
to keep the inflation at a certain pace.
Yes. Spot on, Jazz, because 6 months ago, if you would have asked me, is there a chance of a rate rise? And I would have just declined it, saying, based on the data that we had 6 months ago, we were anticipating rate cuts until February. So
Yes.
instead of the rate rise, forget about even being steady at that point in time.
Right.
So instead, we saw rate being steady towards the end of December,
Okay.
when the last meeting was with RBI for the last year.
Got it.
And the first meeting, they come in, they check the data from December, and it was likely to go up just because we
Got
had
it.
the holiday season. People do travel a lot,
Correct.
shop a lot as well. So the inflation was likely to be expected to be a little bit higher.
Okay.
And that sort of led to one of the decisions to increase the rate
Got it.
because the inflation is just not cooling down. For someone who has got the home loan in the last 6 months, potentially that when they bought the home or when they bought their house, or whether it's a first home buyer or an investor, they were potentially considering like, okay, you know what, my repayments are say $4,000,
Yeah.
hypothetically.
Yeah.
It's going to go down because now we are predicting 1 to 2 rate cuts in
Yeah.
next 6 months time,
Right.
which didn't happen. So it's gone vice versa.
Yeah.
We've got lenders emailing us that there will be potentially a lot of clients who would be struggling with their repayments.
Right.
So they have asked to contact them in case we are approached by any of such clients
Okay.
who are not able to meet their repayments. So I
Right.
think the lenders are also starting to realize that it's going to be a stretch for a lot of home buyers, especially those who have bought it in the last 12 to 24 months.
Do you think lenders were not really aware about that coming as well?
I would say very, very late in the game,
Okay.
because it all just changed when
was
the December
surprise,
data
wasn't
came
it?
in. And I think it was just a couple of weeks before when the modeling started changing for
Yeah.
different lenders. So initially, 2-3 months ago, they were predicting rate cuts. Big four lenders were predicting rate cuts as well. But then they started shifting around as and when the data came in for November and December. And if I was talking about Jan, then in Jan, everyone was predicting a rate rise.
Right.
Because that they were mentally prepared for it. They were sort of knowing that this is coming. It was just about by how much, whether it's going to be 0.25, whether it's going to be 0.5, basically
Right.
at that point in time.
Right.
So, and it was very much evident from the fact that the lenders, before even the RBI announced the rate rise, a week or two before, most of the lenders started increasing their fixed rate loans.
Got it.
So that was an indication for us as brokers as well that potentially we will be seeing a rate
Seeing a
rise
rate
very,
rise.
very soon.
I want to know, and I think a lot of people want to know who are watching, how is your reaction? What are your activities? Let's say you have a rate rise
Yep.
or RBA meeting.
Yep.
As a broker,
Yeah.
what would you be doing in the back end at that time?
So for me, I personally love to connect with my clients, existing clients particularly,
Okay.
Because there's a lot of refinance activities that take place
Yes.
during this time when there is rate rises. We have seen that historically as well.
Does it happen a
So,
lot?
It happens a lot
Okay.
because it gets highlighted a lot as well through
Yeah,
medias,
okay.
through brokers, through banks, because everyone who is a customer with a bigger bank or a smaller bank gets notified about rate rises. And that is more of a direct communication to the customer
Got it.
without involving sort of broker or banker or anyone in the picture. So that's why they would usually come to the broker, hey, I've got this email from the bank.
Got it.
Are you aware of what's happening, basically? So for someone who is not from the finance industry or banking industry,
Right.
they might not be following those news. And all of a sudden, they receive this email from their lender saying, you know what, your repayments are going to go up.
Right.
So just from so and so date,
Right.
yeah, just so that you are aware, make sure you have enough funds in your account. So so it came in as a surprise for a lot of them. For us particularly, when such emails get sent out, customers are coming in and checking with us. whether we are at the best rate now.
Right.
Whether is it just my bank who has increased the rate as well. That's
Or
sort of-
shall we go with someone else?
Exactly.
Yeah,
So
okay.
should we proceed to, potentially go with a bank who is offering cashback or
Got
a
it.
lower rate?
Got it.
So those refinancing activities happens a lot.
Right.
And it's not bad in a way because there are genuinely times when
Right.
customers are at a very, very high rate and
Okay.
then the banks add on top of that another 0.25.
Right.
So we are like, you know what, despite of increasing in 0.25%, we
Right.
actually can still get you a better deal.
Got it.
So might as well,
So it
let's
still
get you
happens.
refinanced.
Is it because of their personal circumstances they were already paying higher?
Correct. Yeah. So a lot of times customers, especially investors, they go for tier 2 banks as well.
Right.
So just because they didn't have borrowing capacity with a bigger bank, but now they
Low
do.
docs and
Correct. Yeah.
Yeah.
So it could include low docs, could include valuation issues in the past, and now they're able to service the loan. Previously they couldn't.
Right.
Could be on customers who are on maternity break as well,
Got it.
so they couldn't service the loan back in the days.
Yeah.
With a single income, they did one, and now they
Got
want
it.
to go with a bigger lender or a better
Okay.
lender. So there has been times, like personally, I've had a situation where I got someone down from 6.8% to 5.25%.
Wow.
So it was almost a 1.5% difference.
You would be
1.5,
godsend for
1.6.
them.
Yeah, exactly. And it was
Especially
on a
in the today's
$700,000
day and age.
loan. So they were saving heaps of
Heaps of money.
money
Yeah,
over there.
exactly.
Exactly. And just by simply refinancing.
And given that obviously when people were projecting that there will be potential rate cuts,
Yep.
a lot of people who were not able to sort of afford the mortgage,
Yep.
at that time, obviously they may have put their plans to maybe buy a car on site.
Yeah.
And when the rate cuts are coming, then you can project that, okay, if you're saving $300 to $400, we can put that towards a new car loan. A lot of people would have taken new cars out as well.
100%. Yeah. Spot on with that, because a lot of when we are getting a loan, we are getting it for this is the normal term
Yeah.
I'm talking about. We would be getting it for a 30-year term, loan
Right.
term.
Yes.
So, and anything can happen in those 30 years. So, if you are someone who is purchasing something today with the prediction that that's going to be for the next 30 years, that's not how it would work, unfortunately.
True.
So, depending on the economic circumstances within
Yeah.
Australia and overseas as well now, we have seen a lot of impacts in the past few years. COVID, of course, was an exception where we
Right.
saw rates going down to like 1.89 as well.
Right.
So, but now everyone is back on 6. And even we are seeing a few customers who had fixed their loans during COVID
Got it.
are coming off fixed rates now, and they're getting a big shock.
Got it.
Because they were fixed at 1.95, 2.25s,
Got it.
5-year fixed terms, which are sort of expiring
Oh,
now,
wow.
and they're coming up to like 6.5, 7% directly.
Wow.
So there has been those sort of customers as well, and plus 0.25 doesn't
Yeah.
help them any better either.
Yeah, wow.
So yeah, it has been challenging for a lot of people in
Right.
Australia, particularly. But yeah, I get it why RBA needs to do what it needs to be, what it needs
Not
to do
needs
as
to be
well.
done,
Yeah.
exactly. So there's something that I've received.
Yep.
I'd like to ask. We've covered off the industry commentary as well.
Yep.
Potential
Yeah.
of further rate rises or rate cuts.
That's the question of the hour, Jazz, I think. And exactly the question I think most of my customers are asking, hey, Sawmill, what's happening in next 3 months' time, 6 months' time? General rule of thumb, we don't know. We can only predict,
Got it.
but we don't know whether that will happen or not.
I was asked this question again. Correct me if I'm wrong.
Yep.
I've answered this question that even last year,
Yep.
when banks were saying there will be rate cut, rate rise, rate cut, and I said the biggest of the biggest economists
Yep.
were wrong
Absolutely.
in many cases as well.
Absolutely.
So it's so hard to pinpoint.
Yep.
But again, at the same time, looking at the data, what would be the motivating factor
Yep.
for RBA
Yep.
to reduce the rate next meeting?
I think if the inflationary pressures are coming down,
Okay.
or at least remaining steady,
Right,
they might keep the rates on hold or
Okay.
potentially look at decreasing in the longer term.
right.
I don't think so personally that it's going to happen anytime soon, to be honest, because they would want to study and have backing of data over a certain period of time
Right.
before they start making calls of rate
Reductions.
cuts in
Yeah.
future. There is prediction, however, though, from bigger lenders
Okay.
that there might be one more rate rise in the next
Okay.
3 to 6 months.
Okay.
And potentially that will break even, and then potentially we can start looking down from
Rate
there.
cuts again.
Yeah.
Do you think they've just mixed up the pattern so people don't? Do you think it is also to sort of not build confidence in the buyers if they're going for, because the frenzy started again
Yep.
after rate cuts? Do you think this pattern, which would be as a human being,
Mm-hmm.
if I were to sort of commit for a larger loan again,
Yep.
I would also be questioning myself twice?
Yep.
because there's no clear pattern. You can't predict the market. Most of the markets, either money market or gold market or share market, works on sentiments
Yep. Yep.
as well.
Absolutely.
And obviously with the commodities, it's also about demand and supply.
Yep.
Less demand and supply, of course, vice versa.
Yep.
With regards to with the finance world,
Hmm.
do you think would that be the case as well?
I think whenever there is a rate rise, right, it gets spreaded around in terms of news or media, or it gets highlighted so much. The fact is, when the lenders are assessing your repayments at the time of loan application, they're actually adding a buffer of 2 to 3%
Okay.
before they actually give you the loan. So, say for
Right.
example, you're getting a loan at say 5.5%.
Right.
They're actually assessing your repayments at 8.5%.
Right.
This is something which a lot of people don't know about.
True.
So even if there is a rate rise of 0.25, 0.5, banks are still going to be okay, because, or you are still going to be okay most likely,
Right.
unless your financial circumstances
Yeah.
have changed significantly.
Yeah.
That's a different story.
Right.
But because it gets highlighted so much that it might start, bothering you so much as a customer. Psychologically, exactly. And moreover, like, we are still, as brokers, are sort of bringing that calm for the customers,
Yeah.
saying like, look, okay, in terms of dollar value, how much it's going to go up.
True.
So if you are someone who has got a lending of over $1 million or 2 million, yeah, that might be a significant chunk of your
True.
money. But if you are someone like a first home buyer and getting you nervous, you might want to just fact check in terms of what and how much your repayment is actually
True.
going to go up by, basically.
Uh-huh.
And a lot of people, they would have got a repayment direct debit setup already in place, which would be at a higher amount than the minimum
Right.
repayment. So a lot of them don't even feel that the rate rise is impacting their repayments. So say
Right.
for example, their minimum repayment is 950 a week,
Okay.
but they have got direct debit set up at 1200
For the bank loan.
for the bank loan.
Okay.
At a higher rate, even from 950 it goes up to 1050. They would still not feel the pinch because they're still making a higher repayment at 1250.
Right,
anyways,
because they're trying to stay ahead of
of the loan.
Okay.
So we saw a lot of those customers during the rate cuts because people left their direct debit as it is, and rates kept going down.
Yeah.
And they never changed their direct debits.
Okay.
So that ways they were actually ahead of their loan without even realizing it.
Got it.
So their repayments, minimum repayments did go down, but they were
Right.
still making the original payments that they were making
Right.
when they got the loan. So
Right.
this is something which a lot of customers don't realize when there is just one rate rise of 0.25 or even
it.
maybe two at most.
Okay.
But then when it starts going beyond, that's when you start getting cautious.
Exactly. But what would you recommend? It's a really good point that you've said, because a lot of people say that if you keep doing an extra, let's say $300 payment,
Yep.
you might bring it, you might pay it off in 20 years, for an
Yep.
example.
Yep.
A
Yep.
lot of talk about that.
Yep.
Would you do that, or would you advise that, or would you rather keep the money in the offset
Yep.
and keep making minimum repayments and reduce the interest?
Yep.
Do you think it's pretty much the same thing, or no?
See, I'll explain you how it works. When it comes to keeping money in your offset account, you can actually access that money towards your day-to-day expenses as
True.
well. So you get a debit card along with that, which you can go out and shop at
Shop
your
around, yeah.
local supermarket.
Right.
And you pretty much use it as your daily normal current account or savings
Exactly.
account, however you like it to
Right.
call it to be. But when you put in extra money towards your home loan in the form of a redraw, that actually sits within your home loan account. So you can actually withdraw it, but there's a separate process for it as well.
Got it.
So it's critical to understand how these two functionalities work with the
Got
bank.
it.
Coming to the interest rate, of course, it's not a tax advice. So it is subject to checking in with your
Of
respective
course.
accountants for that matters. But then a lot of people that I've noticed, what they do, or a lot of investors particularly, what they do is they leave their money more, if they've got a surplus, if they've got surplus funds in their account,
Yeah.
they would like to invest it against their investments so that they get maximum tax benefits out of it.
Right.
What happens is, if you leave money in your home loan account, you're potentially not getting any negative gearing benefits against your home,
Right.
the property that you're living in.
True.
If you leave, or if you invest that money into an investment property, you sort of getting negative gearing benefits, potential capital growth as well.
Right.
But again, as I said, this is not a tax advice.
Of course.
It is subject to everyone's
Personal circumstances.
Correct, yeah.
Right.
And even in matters like, a lot of people who are a little bit conservative when it comes to using their funds, they like
Right.
to keep it in offset. So the way it works is, you still end up paying your repayments,
Right.
you just pay it off quicker, basically.
Got it.
Because you are getting charged interest. So say for example, you have got $1 million loan, you have got $200,000 sitting in your offset account.
Right.
You're getting charged interest only on the 800,000 component.
Right.
You're not getting charged on the full $1 million.
Got it.
So that's how it works and offsets.
So it pretty much, obviously you're paying more.
Yep.
But you're still paying the same amount of interest. If you have more repayments, plus if you have more in offset,
Yep.
it's actually much better. It's actually like a turbo.
Yeah, if you think about it, if you have funds in your offset account, you don't really have to worry about the interest rate for that much amount.
Correct.
So even if you're someone who is paying P&I repayments on an owner-occupied property and you have got an outstanding loan balance of $500,000, but you also have $500,000 sitting in your account, offset account, you're technically not paying any interest.
Correct.
You're just paying principal.
True.
So even if it is at 9%, 10%, or even 6%,
Exactly.
you don't really need to refinance.
Correct.
Or even worry about those.
Exactly, because you're not paying any interest.
You're
on
not
it,
paying any
virtually.
interest. Yeah.
Virtually.
So even if with RBA, if they keep increasing rates,
Right.
it still shouldn't matter to you because you have got sufficient funds sitting in your offset account.
That makes sense. Perfect. The next question comes in is someone's trying to ask a question around off the plan lending. They've been having a lot of issues lately.
Yep.
With the valuation.
Yes.
What's your take on that?
I think it's something which we have seen getting into. Sorry, I think it's something we have seen happening a lot more often in the past. I would say about 2 years or so, particularly for properties in Victoria, where a lot of the planned properties are actually getting undervalued for some reason. Could be multiple reasons behind it, but that is not across all the properties or anything. But it could be particular pocket or it could be particular suburb where it's coming down.
Got it.
And with particularly off the plan properties, because the valuers don't usually have so much of data around for nearby properties.
Comparable sales.
Correct. Yeah.
Right.
So they usually value based on a contract which they think is not fairly valued. Could be for the build or could be for the land component as well.
So do they review the building contract
Yes.
to value those properties?
Yes,
or?
spot on. So when we lodge applications for a person who is looking to make a property at the end of the day, we provide valuer with the build contract as well as the land contract.
Right.
And there have been times when either the land contracts come in short or build contracts come in short or both. So and that's particularly happening with Victorian properties as
But do you
such.
think the land contract would be a problem before the land gets financed? Or sometimes it's a problem with the land even after they've settled?
Yep.
Bank has already given the loan.
Yep.
Does it happen that the land still get valued at less price?
Yes, it comes down to how long the valuation was done before as well. So for example, if somebody has settled on land and they didn't had a build contract at that point in time. 3 months later, they decide to finalize with the builder, which builder they want to proceed with. Builder gives them a contract value. We go with the bank where they not only assess your land value, but they also add build construction cost on top of it and then value as if the property is fully built and completed as a package, basically. Now, in those instances, the interesting part we are noticing of lately with certain properties is the land value remains the same, but in some instances, the build values are coming back much more lower, I should say, because either the build contracts are inflated with, it could be some of the non-standard builders as well.
Got it.
And because of that, the build contracts are either inflated. So it's very, very critical that you should ideally go with a builder who is, registered, who is standard builder, who is approved by HIA, because they are the ones who are sort of allowed or, sort of legally doing things.
Right.
So
that is also a concern. It's not just about lending is the only problem of valuations on off the plan.
Correct.
It can also mean that it's about the builder that you're going through.
Exactly.
Tell us a little bit more. Any example where you felt or you've dealt with a case where there was a builder, you may have got them to change a builder?
Yep.
Or maybe you change a bank?
Yep.
Any situation that might give an example, an analogy to this?
I can let you know about a recent example that one of my clients actually went through. So the client actually ended up purchasing a land. She didn't have the build contract at that point in time. So she ended up purchasing the land. She settled on the land directly with the lender. So I was not involved in that transaction at that point in time. She decided to progress with the build. Once the build contract was signed, she went back to the lender asking for the build loan. She didn't get what she was after because the build valuation came back lower. Now that is the challenge when you go with single lender or directly with the lender. If you have
Okay.
valuation issues, you might not have the option to switch. So the lender would had
You mean they can't switch after getting the valuation come down?
yeah. So either they have to contribute more. So say for example, it
Okay.
came short by $100,000. In
But
my
they can
example,
change a lender after that?
they can change the
can?
lender,
Okay.
and but then they can't do it directly with the bank, right? Because when they go directly with the banker only can support them with their products,
Correct.
not for any other
True.
any other bank's products,
Exactly.
basically. So she came to me, she told me like this is what has happened, 100K short valuation on build, didn't had savings.
100K short.
Yep. But it's independent valuers, so it could be one valuer valuing a property at a different
Exactly.
price, and the second one would be at a different price, and it could be completely poles apart. And which is what happened in this instance,
Yeah.
because I was taking her out of lender A because the valuation came in short with them.
Okay.
I took her to lender B, where we actually got on contract valuation
Same thing.
for the same thing within a span of 1 month.
Same valuation company?
No, different valuation company.
Okay.
But with a different lender. So
Right.
valuers are usually third parties or independent
True.
valuers, which have tie-ups with banks.
Right.
So even the bank valuations firms are not involved in making those decisions. Those are third-party valuers.
Do you think sometimes it's not the company or their policy? You reckon it's that independent person? What they feel, what they perceive about the property?
I think they also go by what data they have got,
Okay.
and with off the plans particularly, they would have very limited opportunity to explore what other properties are getting sold
Right.
for in the area, or what sort of valuations they have got. If there is a particular valuer belonging to a company, they only have data for their particular company.
True.
They won't have data for potentially for the other valuer's
Yeah,
company, basically.
True.
So it comes down to independent decisioning for sure.
Right.
I'm sure they've got their own parameters that they go into and
Right.
assess the property value. But once they confirm the property value,
Right.
that's the final decision the bank has to follow, basically.
Mythbuster.
Yep.
Do you think sometimes if is it subjective? A lot of people say that.
Yep.
So you would probably be able to answer that. Do you think the valuation companies,
Yep.
when they come to value a property, if they value a property less, let's say in established or off the plan,
Yep.
would that be also reason that the banks have enough books for that month or targets, and the valuation companies have been instructed to go strict on them, and some lenders have KPIs to achieve and they go a little easy? Is that a fact or no?
No, it's not clearly, and I can certainly tell that's an absolute myth,
Okay.
because valuers are independent companies.
Right.
So if somebody is ordering valuation through, say, and this is just for example, if they order valuation through, say, through CBA, for example, the same valuer could be doing work even for Westpac, for
True.
NZ, for Firstpac, could be any of those lenders
Yeah.
as well. So valuers, they get assigned those tasks from different banks. So they are not particularly assigned for that particular bank
Got it.
that's relying on their targets or KPIs.
Right.
So regardless of what the outcome is
Got
from
it.
the bank's end, the valuer assesses properties independently.
Independently.
Yep.
Right.
And I think that is one of the reasons why banks actually trust those independent valuers.
Okay.
Because they're not coming in with a biased opinion of the local market, or even based on what the banks
True.
would suggest, or the brokers would suggest as well. Like
Exactly.
sometimes I've seen brokers pushing through to the valuer saying like, you know what, you have really undervalued this property, but then they might have got their own parameters as well. And sometimes
That is
we
true.
have been successful in challenging valuations as well.
Hmm.
If we are able to provide more comparables, I've personally challenged a valuer where we were able to actually increase the contract property valuation by almost $70,000.
Was that off the plan or?
It was an established property actually.
it.
So, and my client was actually refinancing
Right.
out, and they couldn't get good valuation initially.
Got
but
it.
then we were able to bump it up
Right.
based on the evidences and comparables that we were able to provide.
Because
them.
sometimes there's not direct comparables available.
Correct.
And this is a really good learning curve for a lot of people. If let's say for an example, you've got so much of an upgrade in a property, and you've added an extra bathroom, or
Yes.
maybe you've added an extra bedroom, or you've extended the house,
Yep.
or perhaps you've probably redone the whole house itself.
Yep.
But there's no comparable sales
Yep.
in the area.
Yeah.
You don't really have to find the direct comparables.
Yep.
In my opinion, and based on sometimes what we do with the way we do the numbers,
Yep.
is sometimes you pick the average properties,
Right.
then sometimes you pick sometimes a larger size properties than that, and then you sort of mix it up a little bit, and then you do an average where if the properties which are inferior and maybe bigger doesn't have to be maybe better than this particular
Right.
property.
Yep.
You can work out the numbers if the bigger land size and a bigger house is selling for this, and houses which are similar to this but unrenovated
You're right.
or
Yep.
less upgrades, they're selling for that. This is where you should be.
Right.
That could be an argument. I remember that we were working on one of the files
Yep.
where the argument did work.
Yeah, exactly. So I can give you that example as well, where one of our mutual clients actually they ended up getting a shorter valuation.
You remember,
And-
yeah.
and we were refinancing them out.
True.
Because they wanted to get equity out. So
Right.
we couldn't afford a lower valuation.
Correct.
And there was only one particular lender that we could progress with.
Exactly.
During that client's time.
Right.
So we had to challenge the valuer because luckily I got some good comparables from your end as
Yeah.
well in terms of how the numbers are actually in
Correct.
fact on the ground and how
Correct.
the properties are selling out for.
Exactly.
We were able to challenge that. We were able to reach out to the state manager
Right.
of the valuation firm.
Wow. You went to.
Yeah,
Wow.
so as brokers, if your broker is telling you like they can't do anything about valuation, I would highly challenge that.
Right.
Especially when you know you have made a lot of upgrades within your property.
Exactly.
Which was the case in our mutual clients'
Right.
home as well.
Exactly.
So if it's like adding solars or cosmetic renovations, that won't add to the valuation.
That's a really good point.
Yeah, but
That's
if
a
it is
really good point.
yeah, but if it is structural renovation, so you have added like another bedroom, or
Correct.
you have added a car park, or which wasn't there previously
Yeah.
when or you added a pool as well for that
Correct.
matters, which is getting very very common of lately.
Exactly.
That significantly improves your valuation.
Exactly. Do you think then in that case, what would you if you have three options?
Yep.
Redoing your landscaping, adding a door to one of the spare rooms downstairs if it's a double or a single story house.
Yep.
Maybe you've got an extra study, you've got a lounge, then you've living and then theater.
Yep.
If you have an option of converting one of the studies into a bedroom, it's enough space. And adding a door.
Yep.
Which one would you pick? Would you add a door and convert it into bedroom, or do a landscaping to sprucify the property?
100% I would go for the door option. Make it
option.
a bedroom because valuation differs between a 4-bedroom house versus a 5-bedroom house.
True.
3 versus 4.
Right.
But landscape is going to be common everywhere, regardless.
Correct.
Usually, like 95%
It's
of the
more
properties
of
would have.
beautification.
Exactly, it is a cosmetic change.
Correct.
But when you
Which
are adding
will
a
deteriorate
bedroom,
in time.
sorry.
Which will deteriorate in time.
Yeah,
as well.
exactly. But when you have a room, that improves the sellability, and I'm sure
Correct.
you can attest to that as
Exactly.
well, because that helps with the valuation side of
True.
things. So, 100%, if there is an additional room that's created within the house,
Right.
that can actually add value for
Add
the house.
value to it.
Absolutely.
Right.
A lot. I've had few inquiries in the past where people have changed their floorings, floorboards. Added a pergola and those sort of things. That usually does not change valuation to that extent.
Got it.
As compared to adding rooms or making structural changes within the house or adding a pool. That is
Right.
where you are calling out significant changes.
Yeah.
Because the cosmetic changes are something which won't change valuation even when you are trying to sell the property.
Got it.
As compared to something like a pool which gets added on. Which definitely
How much
added.
value the pool adds? If someone was to add value in the
Could
pool,
be anywhere from $20,000 to $100,000, depending on how big
Really?
the pool is, how big the land is.
Okay.
So it really comes down to that. Like I've had a
Right.
property in Queensland where one of my customer had added a pool, and they actually got better valuation by almost 60 grand, just
Wow.
because they added the pool since the last valuation was done.
Got it.
And this was like 6 months before.
But would you say it's a smart move adding a pool for let's say 50 grand and then getting an extra 60? Because obviously there will be an out-of-pocket
Yeah,
expense.
it will be. Yep.
And then you are maybe you're getting 60, 70 back
Yep.
for maybe funding a new investment, for example.
Yeah.
Would you rather suggest to someone watching this to rather use that 50 grand to fund the investment?
Yep.
Or still use equity, and then because eventually it'll add value for the future in that particular home,
Yep.
is it just for that moment? Or would you say add the pool for future benefit of that particular property? What would you be advising?
I think it comes down to personal goals and what tax advice they're getting from their accountant as well.
Okay.
So if they're someone who are happy with one home, they don't want to invest anywhere
Right.
or want to have a relaxing lifestyle. Also comes down to at what age they're trying to do these things.
Got it.
For someone who is probably over 55 or 60, might prefer having a pool in the backyard rather than worrying too much about investments.
True.
Versus someone in 30s might want to actually be aggressive and go for investment opportunities, not worry about pool at this age,
True.
and potentially grow up their wealth in that sense.
And how do you see the trend in so obviously we are connecting questions after the question because at the end of the day it's more relevant
Yep.
for people. What would you say that how does the trend and demand or expectations from a property change with age?
I think what a lot of people in their mid 40s or early 50s, I should say, are also strategizing to invest through SMSF, which is
Okay.
becoming a very, very heated sort of topic
Right.
of discussion. And
Uh-huh.
again, possibly we'll need to have another session for it
Of
completely.
course, yes, exactly.
But what we are noticing is like the first home buyers are getting very, very active
Okay.
of lately, especially with the government schemes coming in as well,
Yes.
where they don't have to borrow, with by paying LMI.
Yes.
So 5% deposit plus any stamp duty and fees that you need to pay.
Right.
You just collect for those funds, and the remaining is funded by the bank.
By the bank.
So
yeah.
95% of borrowing is what you're getting from the bank.
From the bank.
5% plus stamp duty and fees. So at that age of 25 to 35-ish, I see a lot of Gen Zs inquiring about that as well, to be
Okay.
honest. So we are noticing those inquiries going up, especially after the government scheme introduction.
Right.
So first home buyers is getting active.
Okay.
10K grant is there,
Okay.
particularly if
For
I
the
talk about Victoria,
first home, yeah.
for the first home buyers, especially if they're constructing or purchasing
brand
a
new
brand new
home,
property.
yeah.
But also even in customers who are beyond 35 and 45, I'm seeing a lot of upgrades as well. So they have been through the first home journey. Now they want to purchase a new home, which is
Right.
bigger, which is better than what they had originally purchased. Probably differences in family situations now.
Right.
So they want to go for a bigger property where they can accommodate their kids and potentially their parents or anyone
Got
like
it.
that. So, and then anyone in over 50s or 55s, I'm noticing them starting to start planning about their retirements, potentially look after for building homes for their kids and those sort of things.
Selling
So,
off the investments.
spot on, yeah. So we're
Would you
seeing that
recommend-
activity happening
Yeah.
across all ages of lately at the moment.
Right. Do you think is it advised? Of course, this is more of retirement plan and advisory as well.
Yep.
You would have a client. Let me put it this way, so it's easier for me to explain it as well.
Yep. Yep.
Someone's getting into that age of, let's say, offloading an investment.
Yep.
Should they be offloading it, or should they be inherit the kids should inherit those properties as well?
Yep.
Again, subjective to whether they want to give it to the kids, but
Yeah,
let's
yeah.
say if the kids are capable enough to manage,
Yep.
would you cash out, or would you inherit the property to your kids?
Yeah, I think it comes down to their long-term goals as well down the line. If they want to retire and potentially travel or want to purchase a bigger property as well, although it's very common to see people in their 60s looking to downsize, but there have been instances where people actually prefer upsizing their homes even at that age,
Right.
because they prefer having kids coming to their places. They
Right.
want bigger bedrooms, they want comfort for their grandkids and those sort of things as well.
Personal choice.
So personal choices, exactly. But yeah, personally, I think it comes down to their preferences in terms of what they want to do with the money.
True.
A lot of them even prefer to sell all of their assets, just keep money in their bank account, just earn interest out of it, and have a good, healthy lifestyle based on
Right.
that, rather than having the hassle of managing multiple properties and a portfolio of properties.
Yeah.
But yeah, to your point, there are instances where they want to pass on to their kids or grandkids, so they would rather prefer just keeping properties as it
Yeah.
is, especially if they don't have issues with cash flow side of things.
Are we going into financial advice, sorry, the accounting advice or legal advice, where if, let's say, for an example, the properties are in company names or trusts,
Yep.
and if the time comes to sell,
Yep.
we can obviously have a super discussion, SMSF later.
Yep.
But would you say is it hard
Yep.
to pass on an asset to next generation within a specific structure when they've purchased?
I'm not 100% sure, to be honest, Jazz,
Yeah.
on that one, because how that works is more of a taxation or an accounting side of
legal.
things, whether there is stamp duty involved,
Got
whether
it.
how does the transition happen, because whether they have to transfer names from their trust to their personal to
Right.
then transfer it to their kids,
Got it.
or whether it's a direct transfer. So I'm not
Uh-huh.
100% sure, so I
Sure.
won't misguide you there.
Absolutely.
But yeah,
Absolutely.
but I would just say one thing though, that trust lending of lately has been a very hot topic as well.
Yes.
So something to be mindful of, that the lenders have become very, very strict when it comes to trust lending.
Right.
So I know a lot of buyers, real estate agents, brokers, and a lot of others, friends and families as well, I would say, were promoting trust about 6 months ago. But then they
Buying
have
in
been-
trust for asset
buying in trust,
protection.
exactly, yeah, for tax benefits or
Yeah.
for whatever reason they
Yeah,
would be
exactly.
buying.
I heard that the news where that ATO is also cracking down
Absolutely.
on seeing whether the
Yep.
claims or the tax offsets are genuine or not.
Exactly. So, and a lot of lenders, they've stopped actually doing trust lending completely. So, we have had one of the major banks who was very, very popular for trust lending, and they've completely stopped doing trust lending now.
Yeah, wow.
And that was like an overnight decision. So,
wow.
so someone who has bought off the plan properties under a trust, sort of settling in late 2026, early
Got it.
2027, they're sort of starting considering options to
Yeah.
actually nominate and transfer under their personal names,
Right.
because potentially they might not even get a loan under trust name.
Got it.
So something to be mindful of, although it has still got its benefits from
Got
a
it.
taxation perspective, which I'm sure accountants can explain in detail.
Of course.
But yeah, from a lending perspective, I just want to let everyone know
Of
on this
course.
podcast today, like trust lending is getting challenging. So
Right.
just something to be mindful of as
So
well.
plan ahead.
Yep, exactly.
Plan ahead. We've discussed the pros and cons of lenders. That's question being answered for Amy. Now, what would be the top tip for today from you before we wrap up? What would be your top tip for people in current time as
Yep.
of if they are about to jump in
Yep.
to the market and they haven't got their finances, or they're about to jump in, they're about to meet the brokers or the banks?
Yep.
What would be that main one tip that you would advise someone who's buying the first home?
I think just don't get alarmed with the 0.25 rate rise. Yes,
Okay.
it is definitely something which is impacting every potential
Okay.
household in Australia at this stage.
Right.
But you have to think from a long-term perspective, from a 30-year perspective, like
Right.
how the house is going to be priced in next 20 years or 30 years.
Right.
Is it worth leaving that choice right now and potentially continue renting? Because when we have seen historically, when the rates starts to rise, the rents are going up as well.
True,
Usually.
true.
So that is one thing that we have noticed in the past.
Exactly.
Won't be surprising if it happens again, if there are series of rate rises in the next couple of years time.
Exactly.
So one thing I would just categorize that as first home buyers and rest of them.
Yes.
So for first home buyers, I would suggest, like, please try and get a pre-approval before you're committing to anything.
Got it.
In terms of shortlisting a property, purchasing a property, or signing a contract.
Got it.
It's ideal, especially if you're going into auctions.
Got it.
It's ideal to have a pre-approval in place,
Yeah.
so that you know what your budget is, how much your bank is going
Got
to
it.
lend you. But for the rest half of it, where we have got investors, where we have got homeowners who are looking to upgrade,
Got it.
please get your borrowing capacities checked with your brokers, with your bankers, whoever it would be.
Right.
Even if you don't have pre-approvals and if you're confident, I would still suggest to get it checked.
Get it checked,
Because if you have got existing lending, you've got a double whammy there, because not only your existing home loan repayments
True.
are increasing, but also the one that you're looking to purchase
True.
is also going to go
gonna
up.
add up as
So
well.
that might have overall impact on your
the-
borrowing capacity.
Right.
So
Right.
just don't think of it from a perspective that, okay, 0.25 on my new loan, that is all I have to worry about.
True.
It's actually 0.25 even on your existing loans.
Right.
And if you're someone who has got a property portfolio of 4 or 5 properties,
Got it.
that's almost like 1% to 1.25%
True.
overall
Yeah.
on your borrowing capacity that it's getting impacted.
Wow.
So something
That
to
is
be
very
mindful of.
insightful. One more thing before we wrap up. Sorry, I'm
No,
keeping
all
you
good.
too long. The pre-approval process.
Yes.
Is it thoroughly checked by the banks when they give a number to a purchaser?
Yep.
Because some of the times we get this question from a buyer for an auction, especially, where they say, we have a pre-approval, but we still don't want to bid,
Yep.
because what if the banks lend me less?
Yep.
Now, let's say if not, obviously we don't know about the credit history. Let's say the credit assessment. Let's say if credit is fine,
Yep. Yep.
everything was to go smooth.
Yep.
Should they be concerned about, let's say if the bank's given them $1 million to borrow
Yep.
in a
Okay.
pre-approval?
Yep.
Should they be concerned that there could potentially be a concern where the bank can turn around and say, no, a month later we'll give you only 800,000?
Yeah, I'm glad you brought this up, Jazz, because there's a lot of confusion, especially with first-home buyers, in terms of how pre-approvals work. So with pre-approvals, there are some lenders who do fully assess pre-approvals.
Okay.
So that means they are assessing your incomes, your expenses, your
Okay.
liabilities, your overall asset position
Got it.
and your expense position. And based on that, they have done the assessment. They are giving you a pre-approval, saying, hey, you can we approve you to apply for about $800,000 in loan amount. And there are some other banks who just do system checks. So
Right.
that includes your credit checks, which you mentioned,
Okay.
and that's the only check they do.
Aha.
So they don't go through your incomes and expenses in details. They
Right.
just go by the data entry that's been done. They don't verify those details.
Got it.
So if somebody has declared like $100,000 in income, but they are only earning $40,000 in reality, they would still assume that the system would still assume that they are earning $100,000, and they would give that
Which anyone
pre-approval.
can do it on the bank's website.
Exactly. So it's very critical to understand which banks actually give fully assessed pre-approvals
Okay.
versus which don't. So it
Okay.
also it becomes very, very tricky, especially if you're going for auctions. If you have the mindset that, okay, I've got a pre-approval in place, but it was just the basic credit checks that has happened, and you're going for an auction, you win the auction, and you go to the bank, and they don't approve your loan because your income is not enough, or for any other reason it
Right.
could be. So really, really critical to understand. And this is something which I would suggest all of your customers to
Yeah.
double check with their brokers,
Right.
whether it's fully assessed or whether it's just
Whether
system
it's
checked.
just the easiest process. or
Exactly.
Basic.
Because and I get it why lenders do it as well, because a lot of applications they do get rejected based on credit scores only. So that's why a lot of banks, sorry, they end up doing pre-approvals just for the credit score part, and
Okay.
they will be like, they'll assume what you have presented to us is
It's
true,
true and correct. Yeah.
and correct, and we'll go by those numbers.
Right.
Not a lot of people do that in terms of whether they want to necessarily declare higher incomes or something.
True.
But there is a lot more than just declaring income. There could be deductions. There could
Right.
be other taxation matters
True.
that's coming across on your pay slips or on your
Yeah.
tax returns,
Got it.
which the system won't calculate automatically.
Correct.
So that is why it becomes very, very critical to have those fully assessed
So
pre-approvals.
again, it's probably best to sort of go with the pre-approval, which is completely done.
Yep.
So you assure that obviously, and do they do credit checks in that as well?
Yes, they do. So they do credit checks. So it's very critical that you only lodge pre-approvals when you are really ready to buy.
Okay.
If you are someone who is looking to potentially purchase property in 2 years' time, there's no point of doing a pre-approval right
Pre-approval
now,
now.
because pre-approvals are only valid for 3 months. So it's very critical. Instead of having multiple pre-approvals lodged and starting to sort of impact your credit score
Right.
unnecessarily, it's better that you can have 1 or 2 pre-approvals.
Got it.
There might be some lenders who are willing to even extend your pre-approval term beyond 3 months.
Okay.
So it's case by case, of course,
Right.
but it is very critical to just apply for pre-approvals when you are really ready
When
with
you
your
really
deposit,
need it.
when you're ready with your stamp duty
Right.
and any other things that's
Does it
relevant.
really happen?
It does happen. A lot of customers, they have pre-approvals lodged well in advance. It expires, and their financial circumstances change in say 6 months' time.
Right.
They are still under the impression that they're still gonna get that loan amount, which was approved for 6 months ago.
Right.
And they end up purchasing something without a new pre-approval, and the loan gets declined because the financial circumstances have significantly changed. And it
Right.
could be as simple as, even if you get a promotion or you change a job for a better pay or something, but then some lenders have policies to have minimum employment period as well. So if
Right.
you're a casual, most of the lenders would like to see you being employed with the new employer for at least 6 months, or you
Right.
have relevant industry experience in the past 2 years.
Right.
So if it is like a week or 2 weeks or a month in new employment, the banks might not be willing to give you a loan at that point in time. Of course, each lender has got their own policies.
True. My top tip will be, again, I would say that go with someone who can actually explore
Yes,
different banks
absolutely.
and bring everything on the table for you.
Yep. So if you think about it, as brokers, personally, I have access to over 45 different lender options. So if we are not able to service your loan, or if we are getting issues with valuation with one particular lender,
Right.
we can easily switch you on to another one.
Another one, yeah.
So there is always going to be solution
Exactly.
if you come to a broker, and there are no
True.
fees and charges for broking services
Exactly.
either. So whatever we
Exactly.
get paid directly from
the
the banks.
Yeah, exactly.
So there's absolutely zero fees and charges for the customers
Right.
who are doing loans through us.
There you go.
So yeah, it's a win-win situation, to be honest.
Absolutely.
Rather than having to go to the branch during their restrictive hours
True.
and getting your loans done usually, because
Exactly.
brokers are usually available more as
Exactly.
compared to the standard branch timings.
And that person
or,
is obviously your trusted advisor.
Exactly.
And that person is obviously holding your hand based on your personal and your financial
Absolutely.
circumstances
yeah,
as well.
it becomes a one-stop shop, Jazz, because
True.
tomorrow if you decide to purchase an investment property, today you are a first homeowner, tomorrow you decide to purchase an
Exactly.
investment property, we can always assist with those
Correct.
inquiries. We already have your details with us.
True.
It's just about asking for some updated documents, and there you
Exactly.
go. We give you your new borrowing capacity.
Just like people have their doctors, their accountants, they need to have a
Absolutely.
finance person.
Absolutely.
Don't forget real estate agents.
That goes without saying.
Thank you so much, Samuel. Thank
No
you
problem,
so much for your
Jazz.
time. It's
Thank
been a
you.
great pleasure having you again.
Likewise.
And I hope people would get a lot of value from it.
Yep.
And we thank you one more time. And we would love to have some feedback come through.
Yep.
And would love to have some more podcasts with Samuel again on perhaps when the next rate cut comes in, or maybe
Fingers
before that
crossed.
as well. Yes. Thank you so much.
Thank you, Jazz. Thank you. Pleasure being here.
Thank you.
See you.
Done.
Done.